some would argue more risk. I would say there's potentially less risk. Like if you are an entrepreneur, you can back yourself, you can be adaptable versus working for someone who has some aspect of control over you. I think there's a lot of adaptability and just solidness that being an entrepreneur can provide. Like you can have multiple streams of income, you can see trends, you can adapt quickly, you can choose your own future.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. James, thank you so much for joining me today. Super excited to chat with you. All right, James, you are the managing partner and co-founder of Amphibian Capital, which is a 140 million crypto fund of funds focused primarily on quantitative strategies. Previously, you had a pretty extensive background as kind of an entrepreneur, and you actually became involved in crypto in 2013. So very excited to hear more about that. But also, one thing that I think that makes you guys very unique when I was doing some research on Amphibian is that you guys invest in some firms or some funds that are BTC and ETH denominated, meaning that the LPs will actually earn BTC and ETH versus USD. So that's a first for my show. So excited to learn more about that as well. All right, James, tell me about your background. How did you get started in like your entrepreneurial journey?
Yeah. Hey, everybody. I grew up in New Zealand, studied abroad at UC Berkeley in California, and that kind of shifted everything for me. I was pretty entrepreneurial growing up. My first like entrepreneur business was selling used golf balls to people at my local golf course. I loved playing golf and aspired to be a pro golfer when I was a teenager. Had some scholarships and things like that in college, but decided I'd prefer to go down the entrepreneur route than the golf route, and pretty happy about that decision. But yeah, I studied finance, was there in 2008 at UC Berkeley, wild time to be there. Ended up winning the green card lottery and applied for it while I was in Berkeley. So that allowed me to move from New Zealand to the States, which I ended up doing in 2011. I spent some time in Europe first. And then I ended up running something called Net Finance, which was one of the largest online and mobile banking events for different financial services companies across the US like Schwab and various banks and credit unions and things. And so blockchain, crypto, all those things started coming out. And so 2013, we started going into it. Actually came down here to Costa Rica, which is where I now live, in 2013, and kind of got pretty clear Bitcoin was going to be big. Got back to the States, didn't know a lot of people investing in it, tried figuring it out myself, and it just seemed very sketchy. There was things like Mt. Gox and these other, platforms, and it just, I don't know, it didn't feel right at the time, so I didn't allocate. But I stayed very much following things. Actually heard a lot about like Hedera and Hashgraph and things back then. I got into the ICO for that in 2017. And I started allocating more properly in 2017. And so that's when things started getting more serious for me in crypto.
Very cool. All right. So tell me about Net Finance. That sounds super interesting. So you were involved in hosting large events for all these major financial institutions?
Yeah, exactly. So I was pretty fortunate. When I went to college, people were like, you should go into consulting, you should go into, investment banking, accounting, these are the kind of law, these are the kind of large jobs people get. And, I was quite entrepreneurial. I was like, that's not what I want to do. And so I had a mentor who said, if you're going to work with someone and you want to be an entrepreneur, you need to learn how to sell and you need to learn how to build products. And so I actually went to London and I ended up getting involved in various industry conferences, like B2B conferences. And it was across a whole variety of events. And so I learned how to sell, I learned how to build product, I learned how to interview people, I learned how to understand customer analysis, I learned research. And that's what I did. And so I did that in London for 18 months. Then I moved to New York. I did it in New York. I did online retail, I did online banking. And then Net Finance is where I started to specialize a little more, focus on financial services with my background in finance. And then I ended up going to fintech after that.
Were folks interested in crypto back in the day, back when you were, hosting these events, or was it like such a esoteric thing that no one was really talking about it?
Yeah, it's pretty esoteric. Like blockchain was interesting for people, but banks move super slow, so it was still very early.
So, okay, 2017. Oh, actually, take me back to 2013 when you first discovered Bitcoin, or it kind of bubbled up. What was you said, it's kind of sketchy, of course, back then, Mt. Gox, that was a crazy thing that was going on. What was your initial attraction? One thing that's a recurring theme on this pod is that a lot of people I talk to are not American, or they're American something else or American Swiss or whatever, but they have this experience going to different countries and using different currencies and whatever. And I don't know, I just feel like that gives people a huge leg up in terms of understanding the initial use case of Bitcoin, which is kind of cross-border remittance, or could be. So what was your initial attraction to Bitcoin?
Yeah. Or even just like the banking system in New Zealand, like if you wanted to like send someone from a different bank money, you could do it pretty much instantaneously. I came to the US and wire ACH is like multiple days. It's painful. It costs money. It's like this doesn't feel good. There's a whole bunch of obviously issues that we're all aware of with the current system. And so what's interesting about blockchain is it's decentralized, it's transparent, it's efficient, it's fast. It's still relatively early, but this is obviously the promise of blockchain itself. And then Bitcoin, as a store of value and as something that I think is superior to gold in many ways. Although it's still nascent. So right now, in terms of a store of value, gold, in my opinion, is still slightly better, but I think Bitcoin's emerging to become in that direction. And so, Bitcoin and blockchain obviously, have their own unique areas, but the promise of blockchain, the promise of Bitcoin, and kind of all the reasons why, people are so driven behind it, is very fascinating to me, and why I started getting involved, investing, and wanting to get behind it.
And then 2017, that was a crazy year. That's basically like when I feel like it kind of hit the mainstream, or like mainstream. It was like the early adopter mainstream, not actually full mainstream. I'd say that we're kind of entering that now with like the Trump coin and other things like that. But Hedera and whatnot. What was that? I don't even know if that was 2017. But during that period of time, what were you most excited about? Because there were so many new ideas popping up, and people were like, "Oh, wait a second! It's not just Bitcoin. It's not just Ethereum and kind of smart contracts. You can build so many different types of applications on top of this technology." What had you most excited back in 17?
Well, yeah, I got so it was obviously like Bitcoin and ETH initially, but then started getting involved in like the ICO craze, and ended up getting involved in like the syndicate, where we had like 100 whales who'd put money into a wallet. You'd like fill out a Google form, and then you just send ETH to an address, and within a few hours, we'd have like $2 to $5 million worth of ETH in a wallet that would go and fund these early stage ICO projects. And the group kind of grew pretty quickly, so we're able to negotiate really good terms, do at least at that time somewhat of a decent due diligence. And yeah, there was some like big projects that came out. Like Icon was like one of the big ones that we did. Hedera Hashgraph. There's a variety of larger ones. And yeah, we just started to build a name. And so 2017, it was super fun and it was amazing. And I think like anyone in crypto, like we've all learned many painful lessons. And if I just kind of kept everything in Bitcoin and ETH and actually not done that, I'd probably be in a much better position today than I was back then. But at the time, the shiny object took over and it seemed like it was doing amazing. And it was until 2018. And then everything kind of crashed and burned. And so learned a lot of painful lessons around tokenomics and lockup periods and, all these kind of things. But yeah, there was a lot of very interesting stuff in the early stage ICO projects.
Very cool. Okay, so you went from kind of being, running this, not, institutional, more informal group of people that were all getting involved in investing in crypto. At what stage did you decide, okay, love crypto, I want to scale up kind of what I've already been doing in a more institutional way, I'm going to launch Amphibian? Like, take me through that initial thought process.
Yeah, so my trajectory was Net Finance, and then one of the companies that was sponsoring it was called MX.com. It was a fintech company. It was kind of like a mid.com, but working directly inside financial institutions. And so I was involved in marketing and sales there. We scaled from about 2 to 28 million users in 3.5 years. And so I started getting more into crypto while I was still working with them and part of that startup. And then 2018, Cinco de Mayo 2018, I left full-time to go into my first full-time venture as an entrepreneur. And so, by then we're back in 2018, crypto was kind of dying, or just really hurt. And so I ran that venture, which was called Empowered. So I did that for a few years. But when 21 happened, I started dollar cost averaging into Bitcoin again, probably in 2019. And then made a large buy in March 2020 when things went down a lot. And then as things started picking up in 2020, 2021, I had a lot of friends reaching out to me like, hey, what are you doing in crypto? So I started a small Telegram group that grew to like 500 people within a few months. And so all of a sudden I was like this mini influencer in terms of what I was doing. And so then it became obvious that there's a lot of people who didn't know what they're doing. This cycle is probably not going to last forever. I learned a lot from 2017. And so how could I create consistent risk adjusted yield, and regardless of market conditions? So that's the initial inspiration of Amphibian. And then I met my partners who wanted to do the same thing, but do it in ETH denominator because they were big ETH bulls at the time. And so that's how we launched, with dollars, and then a month later with ETH. And then, initially Bitcoin, we were concerned about environmental issues, but we decided, after about a year and kind of navigating through all that, we decided we wanted to launch a Bitcoin denominated fund. And so in October of 23, we launched that, and now that's our largest fund.
Wow. Okay. So much to dig into here. Okay. So you wanted risk-adjusted returns because obviously you had experienced the volatility of crypto multiple times, multiple cycles, and you're like, all right, bullish on this asset class. I want something that's smoother. So take me through that thought process. You're like, I don't want to do venture where it's just fully long and then you have the downside potential. I want something that's different. Yeah. Walk me through that. You're like, okay, we're going to first of all, we're going to do fund of funds. That's a big decision versus invest directly. And then secondarily, it's like, okay, we want to find managers that are focused on quantitative strategies primarily, or like walk me through the whole setup.
Yeah. So our thesis is like, over a long period of time, it's going to be pretty challenging to outperform Bitcoin or Ethereum, particularly if you take into account fees and you take into account taxes. And so if we can create alpha on top of the beta of Bitcoin or ETH, and only charge fees on the alpha that we generate and performance and hit a minimum benchmark, we think that's going to be pretty attractive to a lot of people. Like, I think everyone should probably have, if they're serious about Bitcoin or crypto, they should potentially have some sort of allocation to alts they can do themselves. You could invest in managers, but the managers are constantly trading with their fees and with the taxes. It's kind of hard for that to outperform Bitcoin and ETH. So, our perspective is Bitcoin and ETH, alpha on top. That's where the taxes and potential fees come in, if structured the right way. And then, potentially some sort of personal allocation to alts where you trade some alts yourself. And so that's our perspective. The reason we decided to do a fund of funds is a few things. So one is things evolve so fast in the market. Strategies work well for a while until they don't. We're okay at trading. We're not amazing at trading. There's many people who are far better than us at trading. There's people with much longer track records, much stronger at this. They've been doing this for 20, 30, 40 years and TradFi, and then adapted to crypto. And so in the early 90s, in equities and hedge funds, fund of funds was very popular because you had a nascent asset class. People didn't fully understand it. People couldn't do the diligence. A lot of people didn't have the resources to fully diversify. They didn't have the deal flow. And so if you could diversify across a fund of funds, hopefully the additional layer of fees that you would pay would more than make up for the potential alpha and risk that you would get from a fund of funds approach. And so in a nascent asset class, fund of funds makes a lot of sense in our opinion. In a more emergent asset class, it doesn't. Like, if you look at equities now, fund of funds don't make a lot of sense, but in the 90s and 2000s, it did. And so we think we've got a period of time where fund of funds, particularly denominated in Bitcoin and ETH, makes a lot of sense. And so that's why we decided to do a fund of funds approach. And so far it's working pretty well.
Very cool. Okay. So how were you able to identify these managers early on? Because and when did Amphibian officially launch?
We went live in July of 22.
Okay, cool. And so yeah, early on, how are you finding and sourcing these different managers? Because there's so many different there's a lot of managers, so many different types of strategies. Like it's such a big piece of work. I'm like, how do I even approach this? Like which area do I bite out first?
So our sister fund was called Hyla. Well, they are called Hyla. They were called Chainlink fund at the time, which is not the same as the token. But they launched the second fund of funds in crypto. So there's a lot of nuance with how to run a fund of funds in crypto to be compliant, all the regulatory piece, the finance piece, the operations, let alone diligence, portfolio management, capital raising, all the different aspects. And so they had a lot of experience in that. They also knew a lot of managers. Through our partners, we also were connected to a bunch of managers. And so Amphibian's been built off an ecosystem since day one. We have a variety of funds. We have a variety of investors. We have a variety of partners. We've built a Telegram group with the top managers in the space to solve counterparty risk. We have a high percentage of our GP profits that we allocate into funding projects we care about. So the entire intention of Amphibian has been like 1 + 1 is 3, that if you can combine multiple things together, hopefully the whole is greater than the sum of the parts. And so Hyla was experts in the back office and all those things. They also knew a bunch of managers. And so between all of us, we would compile the data and start coming up with our thesis for the fund of funds.
So early on, who are your LPs? Like, just because this is 22, which is, coming off of 21, which was a great year. And then 22 came, which is bearish, but we probably were having conversations before that. But yeah, who are the types of folks that were like, hey, James, this strategy makes a ton of sense. I want to allocate.
Yeah, totally. So initially, it was high net worth individuals. So people in our network, people we're friends with. I think the reason we started this is we wanted something that could ideally target consistent or optimal risk-adjusted returns, that we could repurpose the profits into things that we really care about, and what we think could really benefit humanity. And so with that mission, it really aligned the team, it aligned the investors. It was like, we're doing something more than just trying to make a bunch of money. Like, we're doing something with a real meaningful cause, and people tend to rally behind that. And so we're able to raise like 20 or 30 million out the gate in the bottom of the bear market, which was pretty good. Before FTX, I think we'd even got up to like 40 million, which was great. And so we were pretty successful getting money through friends and family initially to allocate.
Very cool. And so to go back, you had a sister fund called Hyula?
Hyla, so Hyla, Hyla, yeah.
Cool. So Hyla, it was the second crypto fund of funds, you said.
Yeah.
So that must have launched, I don't know, like 17 or maybe early 18?
Very, very early in 18, yeah.
Very cool. And so that person's background, they were already doing this for some years. So when you guys, so what does a sister fund mean? Is that like a partnership, or how does that work?
Yeah, so they have a venture fund of funds. So they did a lot of liquid and illiquid strategies. And they're still running today. So they, so we have like the quant, they have the long, kind of long directional only. So there was 4 partners from their side, there was 3 from our side. So we had 7 partners actually come together initially to launch the fund.
Very cool. Okay, so now Hyla and Amphibian, I guess there's some sort of, it's all kind of this, they're 2 different entities focused on 2 different strategies, but it's all kind of the same group of folks.
Correct. Yeah.
Very cool. Okay. Well, I need to talk to Hyla after I talk to you. Because if you're doing quant, I want to talk to
Yeah, Paula would be great to speak to. I can introduce you.
Very cool. Okay, awesome. So the overall investment philosophy you would kind of say is a, hey, well, Hyla's going ultra long venture, high risk, high return. There, we want something more. Would you say it's lower risk, with more smoother returns, or how do you pitch it?
Yeah. Well, certainly our USD alpha, so that's market neutral, right? So that's ideally uncorrelated to stocks, bonds, real estate, even to the beta of Bitcoin or ETH. We outperformed Bitcoin. So we outperformed last year by about 20%. The last 25 out of 26 months have been positive. So we're just targeting very smooth, consistent, risk-adjusted returns. On the Bitcoin and ETH side, we're aiming to do the same, but alpha on top of the price of Bitcoin and ETH. So obviously there's a lot of fluctuation in Bitcoin and ETH. But my personal perspective is that, like I said, it's pretty hard to outperform Bitcoin and ETH, particularly after taxes and fees across multiple fund structures. And if you can target alpha on top of the beta, it's pretty interesting. Like last year, we outperformed Bitcoin by 14.5% after all fees. ETH was about 17.5%. And we've been working with KPMG for the last couple of years, and we launched a lending product with them at the start of January, where you can structure it in a way where it's done as a lending product. So according to KPMG, more likely than not, it's not a taxable event when you send the Bitcoin or redeem or in the loan. And then how we structure things, we're targeting more tax optimization, working with them, and so it can allow the tax and the fee structure to hopefully be more optimized than a fund structure. So that's been a really interesting addition to what we've done too.
That's so cool. Wait, so I could send some BTC and let's say 10 BTC, send it over, and then you maybe, we'll pretend you guys send me 15 back total. But it's considered a loan, so the taxes, it's taxed at a different rate versus cap gains.
So yeah, there's obviously like a lot of nuances and disclaimers to this, and I probably wouldn't want to share too much in here because I want to have a KPMG opinion letter to like give tax advice. But according to KPMG, more likely than not, when it's structured as a loan, when you lend Bitcoin, it's more likely than not a taxable event. When we call back the loan, the initial principal is more likely than not a taxable event. any alpha that get or variable interest that gets paid out does get taxed as interest income. But the principal doesn't, and then any potential impact in terms of the price of Bitcoin going up or down, more likely than not, also doesn't have a taxable component to it. So yeah, there's like a lot of nuance. And I think that's probably better for people to like speak to me directly on, and for me to showcase our playbook and the opinion letter and all these things. But the theory behind it and to the KPMG opinion letter is more likely than not, we're able to optimize how those things are structured versus a fund.
Super cool. Very cool. All right. So you mentioned that, in crypto, there's a lot of different strategies. There's alpha decay. So, how are you guys approaching this market and looking at different managers using different strategies? Because on your website, you have this awesome, by the way, great website. You have all these decks that you can go into and, dig deep, which is great for me to kind of come up with some questions here. But, one section was like the 4 key strategies that the quant funds you invest in, what they target. Number 1 was market making. Number 2, arbitrage. 3, algorithmic. And then 4, yield farming. Could you kind of walk me through each one of those and how you approach them?
Yeah. So for the most simple, we have 3 high level buckets. One is market neutral. One is like delta neutral, delta one, or like long short kind of strats. And then the other one would be DeFi strategies. And so market neutral historically makes up like 60 to 65% of the portfolio. 55 to 60% of the portfolio. So this would be like the market making, liquidity providing, arbitrage kind of strategies. And so that's a lot of our bread and butter. And so we're kind of targeting with those strategies like 15 to 20% in a year like this, net of all fees. Just smooth, consistent, ideally 3 to 4% a quarter is kind of like what we're targeting with strategies like that. Ideally very little drawdown, just consistent alpha on top of the beta, or consistent alpha in the terms of USD. Then about 20 to 25% of the portfolio is what we call like delta neutral, or long short. And so those would be higher potential alpha strategies, but they can also have more drawdown. So those kind of strategies, are long short, mean reversion, statistical arbitrage, trend following, momentum strategies. So the kind of strategies that you could yield like 40, 50, 60% potentially in a year, but they could also draw down 5 or 10% in a month. And so we try to keep those allocations to less than 5% of our portfolio for any manager, but ideally like 1 to 3% per manager. So it's like small allocations, but we do get the daily data from a lot of our managers, and so we understand how they correlate to each other. And so ideally we have 15 to 20 of those managers in our fund, across the 20 to 25% of the portfolio, and then a number of them are uncorrelated. And so ideally, if one has a bad month, the others have a good month, and then you can start to create potentially more consistent risk-adjusted returns across the portfolio with a basket like that. And so that's like an interesting part of the portfolio, particularly in conditions like we may be seeing here, or if we do see Bitcoin continue to move up, hopefully that could outperform. And then across the portfolio, we could be looking at 20, 25%, 30% annually for those kind of strategies across the entire basket. So that's that part of the portfolio. And the last one is DeFi strategies. So we have about 20 to 25% with some of the top protocols, yield farming, various lending structures, liquidity pools, etc., from really good managers who can diversify across that, create better terms than people would be able to get as retail, and then be able to manage the risk on the DeFi side for that.
Wow. Okay. So a lot to dig into here. So daily data. So all the managers are sending you their data daily?
So we get a report. So we've created a Telegram bot now where our managers will input various data that we ask for, including a snapshot at the end of the month. So they'll do it like once a month, but it will have the daily P&L data from the last 6, 12, 24, 36 months of their strategies.
Are you putting that in the documentation? Like, hey guys, as part of our investment, we actually, would like you to provide us this specific, detailed data, or is that like, do you have to make that in a side letter, or is that just something that they're like, hey, no problem, or is it a little bit? Is it hard to get that from managers or no?
We're at a point now where it's not hard because of just like our track record and how much assets we have and all that kind of stuff. But took a little while to get there. But we've now built like a Bloomberg of digital assets. So we basically have 250 managers with a lot of data, and we can run tens of thousands of simulations across various portfolios and strats and look at Sharpe ratio and Sortino and Calmer and volatility and all these kind of things and see how those portfolios together can play out. We use a Markowitz model. We're developing some more forward-looking models and things as well. But right now we use like a backward-looking Markowitz model. And then, yeah, we run like tens of thousands of simulations. And then we use that as a basis to help determine, potentially what the portfolio could look like. At the end of the day, it's still made by humans, but the data helps drive a lot of decisions, correlation analysis, other stuff like that.
That's so cool. All right. So the market neutral kind of, we'll call it long, short, and DeFi. Are there different, I would assume, but there's not managers that do all three of those strategies, correct? Or are there?
You get a few managers who have like a multi-manager platform, which might have like a little bit of that, but 80-90% are pretty focused in their particular area.
And have you noticed a correlation between, okay, most of the guys that come from TradFi, they're doing, market neutral. Most of the crypto natives, they're doing DeFi, or is it just kind of like actually a mixed bag?
Mixed bag. Yeah.
Interesting. What, in your opinion, if you had to choose market neutral, long, short, DeFi, if you had to choose where you could only do one, obviously this is not real, but just like if you had to, what would you personally choose to allocate your own capital to?
Well, the biggest part of our portfolio is the market neutral side. So I'd say it's probably that. The long short stuff is challenging because, like even this last month, for instance, like it was so unpredictable. You had like 2 or 3 times of these multi-billion-dollar liquidations in a day. You had potential hack with Bybit. There was just like a lot of vol. And so when it's choppy, it's sideways, or it's really unpredictable, it's challenging for those strategies. But when there's like clear momentum or clear market direction, those strategies can do very, very well. So if you can kind of stomach the volatility, then overall, hopefully if you can do the long short stuff right, it will outperform. And now we've got some really good managers, and we've also got a pod structure now where we actually have 2 risk managers that manage 7 or 8 of these. And so finally in the last couple of months, we think we have a way to do these strategies in a really good way where they can manage the risk and set max drawdown limits and make sure those baskets are relatively uncorrelated to each other. So that's very exciting. But ultimately, we're just targeting really consistent risk-adjusted returns. Ideally, at least 10 out of 12 months a year are positive, if not all. Like last year, we were positive 36 out of 36 months across the 3 funds. So market neutral, probably market neutral, DeFi, and long short would be the order. But now that we've started figuring things out with long short, we're taking a little bit more risk because we think that can hopefully help us outperform without causing any more drawdown. So yeah, we'll see how the next few months goes, but hopefully that'll bring some additional alpha for us.
How do you do long short in a quantitative way when the crypto markets are so driven by news? It's like Trump will randomly tweet something and then all of a sudden, up or down a couple billion, right?
I can include in the footnotes or whatever some of our market updates because we kind of do them on a weekly basis. And we have this saying, show me a chart and I'll tell you the news. And so there's some people that I follow that are just brilliant at, TA and technical analysis. And it's quite remarkable how often news shows up just at the right time of the charts, right? And so even this Sunday, one of the people I follow said, hey, on Friday, they were basically like, hey, I think there's going to be some good news that's going to come out this weekend. Like the last few weekends have been really negative. Obviously, it's easier to shape the market over the weekend because you don't have, TradFi and these other people trading. There's also, you can't get fiat into exchanges. So it's harder to move money in crypto over the weekends. But he was like, hey, looking at the charts, like we've retail's, so destroyed at this point, sentiment's so down the garbage, it's time for some good news. And obviously we saw everything happen yesterday with Trump and the strategic reserve. And so, yeah, there's just like a lot of these technical patterns that can play out over time. And if you have enough of the right managers and a relatively low allocation per manager of the portfolio, theoretically, you should be able to do pretty well with that basket.
And for market neutral, is the outperformance due to speed and, I don't know, technological advantage? Like, they have the best infrastructure, therefore they can, submit the most number of orders because they're because they're fast or whatever? Or how do you outperform in a market neutral as a market neutral fund?
Yeah, it's definitely one of the key pieces. So we have one manager. They have probably 100 employees. 80 of them are double PhDs, like mathematics, just brilliant, smart people. They've been doing this since 2014. They've like built so many little hacks and little algorithms and other stuff like that. They've also got really low latency. And so that certainly can help. Really good market making infrastructure is really important. But also they've just been around enough and just built so many like little tweaks and things and quant strategies that they can outperform. So it's a combination of technology as well as experience and what they've built out.
And on the DeFi side, is that more protocol selection? Because is it you have to be really deep in the space to understand, this DeFi protocol is actually the ideal one to farm versus, this one that could fail?
Yeah, protocol selection, size, so you can negotiate better terms, risk management, so you can understand the audited smart contract, but also have proactive measures in case there's any potential risk that starts to show up. Good terms, so you can potentially pull anything if it looks suspicious. And be able to diversify across multiple protocols.
Very cool. All right. So on your website, I believe you have a really cool document that goes through your diligence process. There's like a whole scoring system. It's like, I think it's like 85, I don't know, 85 points. I forget the exact, but I want to learn all about your diligence process because it was super exciting to run through that document.
So we're diligenced over 700 managers now in the space. 80% we can discount pretty quickly. So we have a basic scoring system that'll look at returns, length of performance, assets under management, Sharpe ratio, volatility, all these metrics. And we can tell pretty quickly if someone's going to be a general fit for us or not. And so that'll discount a lot of people pretty quickly. For those that do make it through, we have a guy in our team called Ross, based in Australia. He used to work for a DeFi fund. He'll go and start the initial diligence process. And so after going through decks and the fact sheets and anything else they send us, he'll do a 30-minute call and start asking deep questions around the team, the experience, strategies they run, how they performed, how they perform in various market conditions, all those kind of things. If that goes well, then we will send out like our diligence questionnaire or our integrity checklist. And so there's a lot of different questions in there around the team, security, risk management, potential counterparty risk, all the various elements that we need to understand. And they'll go into a variety of different questions to understand the manager and how they think about their portfolio. And so that's the next piece. If they complete that, that also includes daily P&L. If they complete that, that goes well. We run the daily P&L. If it looks interesting, potentially could add value to our portfolio. The ideal manager is someone who's not correlated to what we already do, ideally meets or exceeds our performance targets while staying within the drawdown limits. That's kind of like the sweet spot that we're constantly looking for. Then I'll get on and do a deeper call with them, really suss them out, feel them out, go through some of the questions they've said to us, make sure what they're saying seems to check out with what they've written down. We've obviously run like a lot of the daily P&L data. If that all goes well, then we typically will check with fund admin, auditor, make sure that they are who they say they are, they're doing what they say they are. We can oftentimes check with previous investors or current investors to also verify that and due diligence. And then we're getting software around background checks that we'll be implementing shortly to make sure that they don't have any, records or anything that could potentially diminish them or indicate potential issues with who they are. And then if we go through all that and we decide as a team we may want to allocate to them, then we usually start pretty small, like max 1% to 2% of the portfolio. And then we kind of follow and see if they actually do what they say they're going to do. And then if things go well, then we gradually start to increase allocation because of the size that we're at and now continued growth. We typically do side letters very early on and negotiate favorable rates with them.
Very cool. Wow. Okay. So you said you diligence over 700 managers, which is that's incredible. And you said you discount most of them pretty quickly. What are not to give away your secret sauce or anything, but like what are the signals that you're like, all right, this is probably not for us? What are the easy, nope, this doesn't work?
Drawdown, like if they have a max drawdown percentage that goes beyond ours, that's pretty easy. types of strategies. Like if they have any major directional strategy, then it's likely not going to be for us. If it's very short term, we're open to that. But if it's if it's very clear directional strategy over a long period of time, that's not for us. If it feels like the team's inexperienced, or there's just any clear issues based on how they're responding to us or speaking to us, or just anything feels slightly off, that's typically can be a no for us. Yeah, and then just looking in various years, like how they do in 24, how they do in 23, how they do in 22. Yeah, those are big ones. And then obviously, with the fund of funds, right now we only invest in funds. We had a period where we did SMAs where they could trade inside our infrastructure. If someone's a fund, they typically have an audit, or they have a fund admin, so they can verify some of the returns and things. SMAs is a lot harder to diligence, but we are preparing to launch a new fund in Q2, where we will have more SMAs and a professional team to help manage that.
So yeah, what is the minimum length of operating a fund, or maybe let's say minimum number of months that you need to see returns for? Like, can someone come to you with 6 months of history and be like, hey, listen, we got a fund administrator, no audited track record yet, but our fund admin is here, and look, we got $6 months, or is that too short?
No, we'd be open to 6. But ideally they've got some prop money and stuff that would be longer. But if it's only 6 months, then it's typically we're going to take longer before we allocate larger amounts to them.
That makes sense. Okay. So, and then also you said, you start slow, 1 to 2%, increase from there. You said you'll increase based on, first of all, performance, but second of all, if they're doing what they said they were going to do. Have you seen large discrepancies between, hey, guys, this is our strategy is ABC, but then you start investing and they're like doing XYZ, and you're like, wait a second, guys, like, even though your performance is still good, like, you're not following the script that you sent us or told us. Like, have you seen that? Or is that common, or is that pretty uncommon?
In the SMA stuff, it's very common. Like, you have to be really careful. In the funds, it's not as common, although it can.
What is that? And also these are hedge funds, which I assume the minimum lockup is 12 months, like initially, or can you reduce that initial lockup to like something like 6 months or a quarter?
We have terms with almost all of our managers for 30 days. So
Wow.
yeah. So we can be pretty efficient if someone is not doing what they say they're doing, and remove them from the portfolio.
Interesting. Okay. Yeah. And I guess, how do you identify if people are, I don't know, fudging the numbers, or kind of like, I mean, this is like during the diligence process, if people are being, not, they're not fudging the numbers, they're not straight up making false claims and whatnot, but they're kind of, they're making things look prettier than they actually are. Have you experienced anything like that?
I mean, we've got enough managers that we follow, so it's pretty obvious if something starts to go outside of that. So based on certain market conditions, like we have clusters of strategies, right? So we can see if there's if someone fits in with a cluster, even if it's relatively low correlation to the others, we can usually tell like if they're following what they say they're doing. A lot of our managers we get daily reports from, if not at least weekly reports. And so we're constantly watching all those just to see how managers do. Like we've got one manager that I took some time to like really watch them and their patterns. And based on their strategy, we kind of would have like typically a max allocation to like 3 to 5%. But I've been watching them, and there's just so much consistency with what they do that now I'm willing to go like 6 to 7% of the portfolio. And then vice versa, we had, managers that were saying they were doing certain things. It was very clear they weren't. We ended up like pulling our assets from the fund, and then 2 months later they shut the fund down.
Wow. That's crazy. Wow. So, and these funds, they're not, a lot of them, I would assume, don't have full audited track records. They have fund administrators, which is kind of like stage one, but to make you feel really safe, you want a full audited track record. How do you deal with that? Or do most of the people you are involved with have full audited track records?
So a lot of our major portfolio, like our major positions do have audited track records. Like they've been around for a while. Yeah, every fund has an admin, every has an auditor, but not all of them have the track record yet. But the more major positions, typically we've worked with for multiple years, so we feel really comfortable. And it's also pretty obvious if someone's having issues with a fund admin, because every month we'll notice, we get estimates from them, and then depending on what their fund admin will say, will help us really dictate, like, are they really on top of their back office and their operations or not? and then we check the audit to mirror it. But in general, there's relatively low discrepancy for the managers with their audit versus the fund admin, if the month to month is consistent. But we certainly have managers who it's clear they don't have their operations in order and their things, and so they might be like, hey, yeah, we're up 1.5% for the month, and then admin comes back and they're up 20 bips or maybe even potentially negative, and we're just like, hey, what's going on? And as soon as we see any sort of yellow flag or anything in that, we're very careful, because typically if there's some sort of operations or back office issue, there's oftentimes issues happening across the rest of the org, so we're very careful with that.
That makes sense. In terms of, have you identified correlates of success, or just general correlates where it's the people that tend to outperform are, usually a team of 10 and they're based in the US, or, they're 50% PhDs, or have you identified any of these correlates, or is it relatively random?
Typically more than 100 million in assets, have been around at least 3 to 5 years in crypto, have a TradFi experience, very intelligent, have some sort of unique strategy or something that's unique about them. Very responsive, very transparent. Yeah, I would say those are some of the traits.
Very cool. Would you say that your diligence process, if you could improve one thing about your diligence process, what would it be?
I think there's a lot of things that AI is going to be able to help improve. One of the things I'd like to do this year is, particularly if we launch this institutional grade fund with some of the SMAs, we're effectively going to have two teams. So we have Amphibian Capital and then Amphibian Dunamis Capital, which is what we're launching. And then ideally I'd have 2 COOs. So have COO for Amphibian Dunamis. He's currently kind of split between both. And then COO for Amphibian Capital. And so if we can get the right person in there, and then have a couple of people that we hire under them, and they can start to build up better software and better agents, or start to build our AI agents. I think there's things agents can start to look at and go deeper into, than a human. I think we do a good job. But I think, if you look at an 80-20 rule, we certainly nail the 80%, probably even 90 or 95, but there's always little things. But I feel if we had AI just going and scraping every possible thing and looking for potential little things, we could maybe unearth things slightly earlier than we would. I think it's unlikely anything major would surface, but it still could. But I just think with AI, there's a lot more that can be done. It can handle a lot more complexity than a human.
Very cool. Yeah, it's unlimited scalability and diligence. It's hey, go look at Andrew's entire social history and tell me if there's any red flags, or because I guess a lot of the diligence and kind of the tracking is just based on the actual returns, because I guess the person's social media could be unhinged potentially, but if their performance is really good and consistent, it's that's matters more potentially. Depends on the LP and whatnot, but
Sure.
so how do you source managers today? Because when I go on, it's funny, on Twitter, I you see a lot of the crypto VCs, and they're all talking, and I talk as well. I'm probably in that bucket, fortunately or unfortunately, and saying thought pieces and what's the future, etc. Versus the more quantitative crypto fund managers are much more low key, and it's hard to find them. You have to kind of search on LinkedIn. How are you sourcing these managers today?
Yeah, we have a pretty extensive team. And then we also have this Telegram group called Amphibian Unite, which is about 180 managers, or 180 of the top traders in crypto. And so typically between a handful of people who specialize in helping people source managers, our GPs, our team, those managers, the reputation we have in the industry, we get a minimum of 3 to 5 new managers coming across our desk every month, if not more. I had another one this morning. There's just constantly new managers in the space emerging. And then, our brand is growing. We're getting out there more. And so sometimes we get people who reach out to us as well.
Very cool. And this could be a dumb question, but how do you differentiate between, luck and skill within the quantitative, within the quantitative managers? Is it purely based on their track record and their consistency?
A lot of that is the case. I think crypto is so volatile and it shifts so quickly. It's quite obvious who's who's got true skill and then who's lucky. Like we had a manager we had a small percentage to that did very well in like February and March last year. And so we were like excited about them and we increased the allocation a little bit. And in the next quarter, they did like okay. And they slowly started to fade a little bit. And now they're just like very average. And so they had some strategies that did amazing for a couple of months, but they weren't able to sustain it. And so that's the differentiator. Versus we have another manager that did incredible most of last year. They had like a couple months where they were quiet, but we were just like, we just trust this is just kind of like a lull and things like that. And then sure enough, they continue to be strong. So it becomes pretty obvious like who's really good and who's lucky.
In terms of alpha decay, what are your thoughts there? Because, as you mentioned, crypto's constantly moving. It's like the most, I don't know. I feel like every day there's new updates and things change, whether it's from like a government perspective, or regulatory perspective, or a technology perspective. So, do you think that alpha decays faster in crypto versus TradFi? Or, I guess like how do you think about keeping up with just generating alpha within this ecosystem?
The good news about crypto right now is there's lots of new innovation. There's new things happening all the time. The market size ideally is getting larger and bigger. And so, yes, there are new players coming in, but ideally we're getting a larger market size plus new strategies and new things coming in. Plus there's just immense amounts of volatility in crypto that doesn't happen in TradFi. So I think there's opportunities. And, so far since we've started, I don't think we've seen a crazy amount of alpha decay. But I definitely think it's on the horizon. And so this is where like us nailing the long short stuff is so important, because typically yields, market neutral, and efficiencies, all those things over time will continue to decline. But ideally, if you can get the long short part right, then hopefully you can outperform, but it's more challenging. So there's just like, that's where I think AI is going to be really interesting, is ideally with the launch of this institutional fund, we can have enough GP and equity investment to launch like an AI accelerator incubator that can allow us to continue to develop strategies and stay ahead of the curve.
So now that we're on the topic of AI, well, it was brought up before, but I want to dig deeper here. Do you foresee a future where there's going to be AI managers and humans are going to be completely removed like from the loop, or is that just like that's just not no one can create an infinite money printing machine? Like, what are your thoughts on AI replacing managers?
I think in the phase that we are now, AI is going to assist. I think whether it's in SaaS, whether it's in crypto trading, many use cases, I think it's very unlikely that people are purely going to trust their money with AI. But I think over time, as people get more comfortable and there's the right guardrails set and the right things, we could start to see that happening more and more. It's going to be really fascinating to see how this evolves over time. I think there'll probably be a certain category of investor, someone who's younger, that may be fully open to just all AI. I think certainly for the foreseeable future, I think people will probably want some sort of hybrid, where there's at least some sort of human oversight and involvement with a combination of AI.
Yeah, because we're talking about alpha decay, and I'm like, man, if everyone's using AI, like, are people going to have sustainable edges for like a day, and then you have to find figure out something new and tweak your AI or something like that? It's going to be so hyper competitive. But you could also, I guess, argue that it's already hyper competitive today, and there's so many people looking at markets and doing different strategies. So I don't know, it's going to get pretty crazy.
Yeah, there's people who will say that you have like the Citadels of the world and these large players who for years have developed such deep algorithms that they're able to outperform, and they still yield today despite that. But certainly over the next 3 to 5 years, it's going to get very interesting. It's something I'm thinking about a lot, of like, how do we stay ahead of the curve? And how does it become an opportunity versus something that could erode us? We actually polled our group about this about a month ago, and in terms of agents, at least for the next 12 months, 80 to 90% of the group saw it as an opportunity versus something that would hurt them.
Yeah, no, it's funny because you see Citadel is now looking to market making crypto, and we have kind of quote unquote positive regulatory changes in the U.S. where more traditional financial institutions are going to become involved. On one hand, I'm like, that's wonderful, more adoption. On the other hand, I'm like, I guess it's going to be less alpha for the people that are in today, right? But I think that it's going to be. I can't imagine. It's still such an immature young market. I can't imagine crypto's not the most alpha rich market for the next like 10, 20 years. I'd be surprised if that's not the case. But
Yeah, and there's so many nuances. Like the firm I mentioned before, who's been here since 2014, there's so many little minor tweaks that they've made that they've built up that even if you had Citadel come in or some others, it's going to take them quite some time to be able to catch up on a lot of things. They will have superior advantage in certain areas, but in other areas it's going to be more challenging for them. So, yeah, I've also polled the group like, do they see Citadel coming in as a positive because it's indicating market growth? We're going to see more assets fluctuate. I also come in because of it, or a negative because they're going to basically eat up the yield. And it was more positive than it was negative, but there definitely is concern over a longer period of time of these larger players coming in. And so I do think moving quickly here, growing in size, bringing the right partners together is very important. And so this year, we'll probably consider a few different things that could help scale us faster and the right partners that could allow us to get into more advantageous positions should something like that start to happen.
Very cool. Can you describe a very challenging situation you've been in during your tenure at Amphibian? I'm sure that you guys have been around for some time, so I'm sure there's been some like crucible moments that you've experienced.
But there's like really two things that come to mind. So we did over allocate some of the long short strategies without the algorithms and things in place and enough of the daily data. And so a lot of the strategies ended up being more correlated to each other than they initially looked. And so that caused us to have drawdown in the first few months, particularly on the dollar side. So that was pretty painful because, we had expectation around what we were targeting and we didn't hit that. And so that was brutal, but it was what allowed us to build out the quant team and the algos and build a better system and, figure that out in a better way. So ended up being good for us, but it was challenging at the time. But certainly the most challenging was FTX. We didn't, we obviously were concerned about counterparty risk. We had limits in place. We had monitoring. We had certain things, but it was just a very challenging situation to go through. I think on the dollar fund, we ended up having about 8% exposure or something like that to FTX. At the same time, we had another manager that actually conducted fraud because they were sending their fund admin spreadsheets as opposed to fund admin checking their bank account. And so that was really tough. Once again, another good lesson, make sure that, fund admins are actually checking bank accounts, not spreadsheets, which is kind of crazy to even consider. But that's now with the SEC, that case. So yeah, that was a challenging, really challenging time. But the benefit of it is it helped us launch Amphibian Unite. So in Amphibian Unite, we have 180 amazing people in there now, the best firms as far as we know in crypto. So even when Bybit had its potential incident on the hack the other Friday, before there was even an official tweet, someone put in there, hey, hearing rumors about Bybit, anyone got any thoughts? And then as soon as the tweet went in, they're like, went in there. I polled the group. I'm like, hey, what are you doing about this? And then people were basically like, I'm watching it. I'm starting to de-risk. I'm doing this. And then after minutes of just like navigating the situation and people kind of commenting back and forth, more and more people started de-risk really quickly because of it. And so that's great to have like a reactive monitoring group consensus conversation be able to happen for things like that. But the ideal situation is tri-party, which means you would actually custody assets off crypto exchanges. And so within our group, we played a large part in supporting both Binance and Signum and launching the first tri-party agreement in crypto. So your assets actually sit in escrow, fully bankruptcy remote off the balance sheet of Signum Bank. You can earn treasury yield while it's in escrow, and then Binance gives you a credit to trade on Binance without facing direct counterparty risk. And so that's been a huge innovation for us. And so our idea is to get more and more of our portfolio live on that product, so we can de-risk counterparty risk. And that'll really be the kind of final key piece for us, is if we can earn some sort of treasury yield plus minimize or heavily reduce counterparty risk, that'll make it very, very strong for us.
That's so cool. Yeah, I was going to ask you about the counterparty risk, and I guess what percent of the portfolio are unqualified custodians? I would imagine because of the strategies, it's very, very minimal.
Yeah. So when we send money to and from managers, it's all done through qualified custodians. But then when they're trading, obviously they need to have counterparty exposure. There's ways to minimize it through different strategies. If you have relatively low vol strategies, you can have some kind of leverage and stuff to minimize the amount actually on the exchange. And there are more providers that are coming out. You've got like Copper Clearloop out, Zodia, Signum, Fireblocks. Kumanu and some others. So it's beginning to emerge more, but it's still relatively low because the technology and the integration still isn't strong. But Sigma and Binance is now live. We're seeing our largest manager put a healthy amount of their Binance exposure on there in the coming month or two. And then hopefully Bybit through Fireblocks will be integrated there in the coming months. And then we've got another bank that's looking to integrate with OKX that would hopefully support us with that exchange. And so more and more over the course of the year, we want to reduce counterparty exposure.
Very cool. How do you think about building out your team? Because you mentioned you have a very diverse team. Are you looking at people with we need someone to manage the market neutral, so we want someone with 20 years of market neutral, or like how do you go about building out the team at Amphibian?
Yeah. So in general, we have a really good team right now. We don't really have any. I don't think we've ever really had any major like turnover in the team so far, which is great. But I think the thing to kind of quantum leap us. So we had an offsite last year in September, and the theme was like, hey, we've done great at raising AUM. We've done really well with our returns. And now we need to optimize a lot of very small processes to be really more efficient and really dialed and build the infrastructure to be like a multi-billion-dollar fund of funds. And so that's really the intention. And so now we do have a part-time COO who's fantastic at HSBC. But in order for us to have both the institutional side and the fund of funds, at some point we're going to need to have him focus just also because we're going to be SEC compliant next year and going for that. There's just different ways we need to structure the org. So he's going to be focused on the institutional fund, and then we'll need to hire like a seasoned COO. And so we have someone in mind who's been at like, Millennium, Sequoia, and a bunch of other Citadel. And then they'll be able to hire out like a software engineer and then like a project manager that can help our back office, middle office, and front office optimize all of our solutions. Because obviously technology is moving really quickly. There's a lot of things we could be doing better. And so I think having someone who really understands trading strategies and has worked at these top firms, who understands crypto, is also vision and values aligned. It's really important for us. We're kind of aiming to be like an antithesis of Wall Street, just in terms of our culture, how we relate to each other, how we speak. We do breath work at the start of every meeting. All these kind of things. And so cultural piece is just as important as their track record and their ability to be best in class.
That's so cool. Yeah. So speaking of the cultural piece, you mentioned you guys reinvest a portion of profits into things like regenerative systems, human consciousness, environmental and social impact things. Tell me more about that. When I was reading that on the website, I was like, oh, but that's so cool. I don't know any firms that do that. So I'm curious.
So yeah, when we started this, it was during the pandemic, and there was a lot of kind of interesting things happening in the world, and I mean there still is. And our belief is that if we want to leave a future better to future generations, ideally we can raise consciousness in the planet. What that means to us is that people are more aware. People care more. They care more about each other. They care more about how they relate to each other. There's so much division. If you just look at politics in the US as an example, there's so much division, wronging, like all these kind of things. And if you actually look at it at the heart, like if you're a Democrat or Republican, you're really kind of standing for something. And I think if people can actually, even if someone has a different perspective, if they can understand what they're trying to say and they can honor and respect that person without wronging that person, could actually help teach them something, even if it's not something they end up fundamentally agreeing with. They're both kind of holding pillars or something that I think could actually be very supportive. And I think the more the people become aware of their actions, of how they relate to things, of how they relate to each other, the environment, these other things, I think we can hopefully create a better world. And so raising consciousness is very important. How we relate to just systems in general, like systems based on scarcity, on centralization, systems that don't factor in externalities. It's just not sustainable, right? Like when you play a win-lose game, it's never sustainable. You see Ray Dalio talking about failure of governments and all these kind of things. And if you play off systems that are based on fear of scarcity, where someone's winning and someone's losing, that's never going to stay around. But if you can start to factor in the full life cycle of things and more factors and start to care about people more and start to build systems that are more in line with that, maybe we actually stand a chance of our children living in a better future than we have. And I think it's quite scary right now because a lot of people think that like for their future, that the children, their future is going to be worse than it is, from what we've had. And so when we launched Amphibian, we wanted something that could hopefully target optimal risk-adjusted returns. We could repurpose the profit into funding those things. We launched a nonprofit called Frequency.is that we now bring community members too who are investors in Amphibian and people in our network that can actually come together, combine resources, and help to hopefully have greater impact together. And so we help fund that initial nonprofit. We're helping to fund projects within that nonprofit. And we're building like a deeper thesis and a deeper map as a collective to help figure out what that world actually looks like. And so that's obviously complex. There's a lot to it. It's still early, but we had 72 people at our last event in December. And our goal is to have 144 members in that nonprofit who are behind this mission, where Amphibian can be an example and then inspire other companies to do similar things, and then have a bunch of resources that from our investors, from our sister funds, from our sister companies can go and, help pull resources together into like donor advised funds and other vehicles to support both nonprofit and for-profit impact projects.
That's so cool. Wow. Yeah, it's really, because I'm in Chicago and there's a lot of traders here, and I'm friends with traders from Jump and DRW and whatnot. And I don't know, recurring theme. When I talk to them, they're all happy with how much money they make. They kill it. But in terms of their impact, they're always like, yeah, I don't really feel like I have that big of an impact on the world because I'm just kind of trading and making money here. And so it's really cool that you guys are adding in that aspect to your business, because it just makes it super meaningful and yeah, very impactful in a positive way. So very, very cool about that. Well, to go back to, kind of the more business aspect, you have a really good view on service providers, because you could probably deal with I don't know, so many fund administrators, so many auditors, et cetera, so many banks and whatnot. If you could wave a magic wand and kind of change or / fix one operational aspect of the service provider side of funds, what would that be?
Definitely the big one that I just continuing to drive that I feel is one of the most important is just the tri-party, is just like the custody with exchanges. And a lot of the time it really just comes down to what exchange is comfortable with, what are the terms they're willing to abide by. Part of the reason we were able to get Binance across the line is because of the number of funds and people behind it in our group, so that helped. But in general, there's still sometimes an apprehension around certain clauses or terms or things, or even tech setup that exchanges, and not always is open to. Plus, just the way some of these technology providers and the custodians set things up also isn't fully ideal. So that's definitely like the number one thing from my perspective that I would love to help improve. And then, this year, just the nature of how we receive statements from managers and, tracking data and all this stuff, I think we're going to have to build out probably some custom software to help manage like our back office as well as our middle office and everything in a better way. There's certainly technology out there that's okay. But we haven't seen anything amazing that could have like a full suite across, both the front, middle, and back office for fund of funds. And so we'll probably have to build something ourselves.
And in terms of LPs, today, I think you mentioned it's high net worth, or sorry, early days you mentioned it was high net worth mainly. Has that evolved to today? And how do you expect it changing going forward, if you do expect it to change?
Yeah, so high net worth individuals is still the largest percentage, but we're getting more family offices, some crypto treasuries now. And I'm in conversation with a couple of nation states. So ideally, we would like to see more family offices, more institutions getting involved. And then potentially a nation state or two would be obviously amazing, or even like a US state that holds Bitcoin. Yeah, that would be the ideal.
Very cool. All right. How do you see Amphibian evolving? I know you mentioned this a few times, but let's call it 10 years from now. Where do you want Amphibian to be?
I think 10 years, to be honest, especially with AI, the pace of change that everything's moving, and how things are going to evolve. I think for our team itself, it's going to be very challenging to be able to like really compete, because the market keeps taking off. There's going to be a lot of big players coming into the space who have far more resources than we have, and it's going to be challenging. And so, ideally sooner rather than later, we're going to find partners that can continue to grow with us and set us up to be able to compete in 10 or 20 years time. So the thing that works for us now is our track record's great. We have some sort of first mover advantage. We have a great reputation in the industry. And so for people who have more resources, who come from a traditional background, can actually be a great partnership, because we understand the space more. We've got the track record. They don't have to start from scratch. And so, theoretically, there could be a partnership available where we could support each other, where they could help bring in more resources, accelerate what we're doing, prepare us to be really ready for this. And then potentially in the future, there's either like purchasing more shares or even like some sort of acquisition that would then allow them to kind of be like the leader in this particular area. So it's an interesting conversation for us as we continue to evolve. Is like if we want to continue to compete, we are going to need to have more resources and experience and scale into these larger amounts. And so we think we don't know if it'll be this year. Like ideally, there's some additional partners that would bring on this year, but certainly in the next like 3 to 5, we would like larger players to come in and align with us to help accelerate things and position their firms also for this next wave of assets beyond traditional markets.
That's awesome. Very cool. All right, James, this was amazing, but it's time for the closing questions. All right. How has being an entrepreneur changed you as a person?
Yeah, I don't think I could ever imagine working for someone again. Like being an entrepreneur to me is like, it's just such an incredible blessing. I live here in Costa Rica. Like I surfed this morning. It gives me the freedom to work when I want, where I want. But it just makes me way more versatile. There's obviously, some would argue more risk. I would say there's potentially less risk. Like if you are an entrepreneur, you can back yourself, you can be adaptable versus working for someone who has some aspect of control over you. I think there's a lot of adaptability and just solidness that being an entrepreneur can provide. Like you can have multiple streams of income, you can see trends, you can adapt quickly, you can choose your own future. And so, I think being an entrepreneur for the right people, it's not for everyone, but for the right person, to me, being an entrepreneur is incredible. Like you can truly create like the future that you desire and create miracles every day if you really choose to.
Amazing. All right. You could go back in time and give yourself one piece of advice before starting Amphibian. What would it be?
Well, I think 2 things. So one is, I think I did every information that I had. I did the best I could. So I think I did great given what I had. But if I could go back and tell myself, it would be both the lessons that I learned earlier of like get the quant stuff figured out earlier and create a group of these people to help manage counterparty risk in a better way. Like those would be the 2 things that I would tell myself.
That's awesome. All right. What has been the most unexpected lesson that you've learned along your journey?
I think when people talk about playing the long game, it sounds kind of obvious, but I think just the pace that I move at now and just how I make decisions is so much more grounded and solid than when I started. Like, I think when you're an entrepreneur, you kind of, they say move fast and break things, but when you're running a fund, you need to be very diligent and very really assess the situation, and you need to have like a slower pace. Like I compare it to like more like earth energy, just slower, more diligent, thinking through things in a deeper way and more level-headed. And so, despite crazy volatility that sometimes happens and having like more than 70 investors in our company and like 140 million and, all this stuff, I'm generally pretty level-headed day to day because I'm just assessing things and, I expect the unexpected and I just trust the process.
Love it. All right. How do you define success? And do you think that you've achieved it?
I think there's like success and fulfillment, right? So like success and achievement are like external things like, hey, I've raised X amount or I've made X amount of money or I've like accomplished these things. And then this fulfillment is like, how do you feel internally? And so I think true success is a combination of both. And I think it's like health, wealth, and relationships that you've got like fulfillment across all of those. You have a meaningful relationship, you're healthy, you're present, you have a great relationship to life. And hopefully you're also creating something that's really impactful and helping people is meaningful to you. And hopefully you're receiving healthy amounts of money for doing that as well. And so that to me is like a really healthy balance of what I would say is true success, is being able to do all those. I don't think the journey ever ends. I think it's constantly evolving. But I would say for the first time in my life, like I'm really proud of like where I am and just all of those. Like we're building a beautiful home in a beautiful regenerative village here with friends in Costa Rica. I surf most days, really healthy, fun's doing amazing, have an amazing partner, Summer. We've got a couple puppies now. I just caught up with a friend who I lived in London 2009 last night, and he was just like, I'm so proud of who you are and what you've created. And so I genuinely feel that to be true.
That's amazing. James, thank you, sir. This has been incredible. Where can people find more about yourself and learn more about Amphibian?
Yeah, go to amphibiancapital.com, which you'll probably share in the show notes. If you want to reach out to me directly, james@amphibiancapital.com, and then just share your intentions for reaching out. We can take it from there.
Amazing. Thank you, sir.
Awesome. Thanks, Andrew. Have a great day.